Well, welcome everybody to the April 30th, it's almost May Day, edition of the Roundtable. And I'm joined tonight by my friends Ken Kavula, Cy Lynch, and Hugh McManus. My name is Mark Robertson, managing partner and founder of Manifest Investing. This session tonight is our monthly roundtable session brought to you by the Better Investing Mid-Michigan chapter, and we appreciate that. And tonight's session, again, if you're relatively new, well, if you're a returning attendee, welcome back. If you're a first-timer here, welcome. And we put this on monthly where basically the four of us, and sometimes with pinch hitters, get together and just kick around some of our best ideas and do a little bit of exploring, a little bit of studying, and things which come natural, and we'll just kind of take it from there. I am declaring tonight to be a tribute, or certainly in tribute to stubbornness. And I think when you see some of our selections, particularly mine, the mode of being a bit stubborn comes to mind. And
well, Mark, I see a somewhat portly knight right next to my picture, so I'm wondering if you're taking a shot at me, and if so, remember, you're sitting right next to the donkey here. So.
I know it. I think both of us are in trouble. Only Cy and Hugh are insulated from this abuse. But
okay.
No, he's kind of our icon. He moves around on the page. Nothing personal intended there, Ken. All right, let's go ahead and get started. We do have to do our normal disclaimer. Again, no investment recommendation is intended. We're going to talk about real companies, real time, give some opinions, throw some trends and stuff on the board. This is for education and illustration only, and we may talk about stocks that we actually own. We do try to disclaim that or disclose that whenever we run into that situation, but that can certainly be the situation. The moral of the story is, and almost everybody here knows it, is do your own homework. Always do your own homework. That's always going to be true. This is kind of our agenda for tonight. Again, we've kind of mixed things up a little bit. We'll kick things off here for just a couple of minutes, and then Cy's going to go into his discussion of first Niagara. We'll talk a little bit about how well we've done. Ken Kavula wants to talk about portfolio recovery. Then I want to spend a few minutes talking about something we kicked around. Some of you that were with us this weekend saw that we kicked around some performance data on clubs going back over the last several years and professional portfolios. We do want to talk about those and put things in a little bit of context there. And then Hugh and I will close out with our selections of RIMM, and then Hugh is going to actually do Southwest Airlines. Just a quick reminder as to why we're here. We don't do this nonchalantly. We really are trying to identify companies which we believe have the potential to outperform over the long term. We really do want to put together a tracking portfolio that outperforms the Wilshire 5000 by 5 percentage points. And again, when we talk about the group performance thing in a few minutes, you'll see where that comes from and why it's there. And we do want, we really would like to see 60 to 70% of our selections outperform the total stock market index after we've had them for a while. So that's the kind of the basics of what we're trying to do. And again, just as a quick look at one of our favorite market barometers, and it has to do with the Wilshire 5000 being the green bars going all the way back to 1999, and the red line is the value line low total return forecast. And again, it's basically a chronicle on the entire market, and you can think of it that way. Notice that during the Great Recession, the average return, the low total return on stocks got up into stratospheric levels. Everything was on sale back here, even when you couldn't get anybody to listen to. Everybody was kind of disgusted with stocks back in that time frame. So again, this just kind of gives us some context. Over the long term, we know that the value line low total return forecast kind of floats around between, say, 0 and 20, just roughly. And right now it's kind of smack dab in the middle, maybe a little bit below the mid-range. So selectivity is important. You might even want to ratchet up your quality or your financial strength a little bit as you do your shopping. But basically kind of nominal or average conditions for buying stocks. You can see that the low total return forecast is 9. We know that my par is right at 7.8 actually as of tonight's close. So again, kind of right in the middle, kind of nominal conditions. So it gives us a little bit of context about how we go out there looking for things. With that, let's go ahead and dive right into size selection for this evening. Take it away, sir.
All right, thank you, Mark. Hopefully I'm coming through. I've heard y'all breaking up a little bit, but I think I am back with you now. My pick tonight, perhaps being a little bit in keeping with our stubborn theme, is First Niagara Financial. I first picked this about 1.5 years ago, and it has not done particularly well since then relative to the market, although it has recovered somewhat, and I think it's reasonably close to where it was when we picked it price-wise. It just relative to the market has not performed well. It is a thrift by history. It's becoming much more. I'm not sure there's a significant difference between thrifts and banks now as a practical matter. They do still come under different regulators, but the rules surrounding their conduct are so similar now in their practice. And in fact, as First Niagara has been doing the last couple of years, they frequently acquire banks. They were acquiring a bank when we picked it last time, actually a bank through the FDIC that had gone under, and are currently in the process of acquiring HSBC in the northern New York area, a little over 100 branches. Here you can see the historical performance. Not a huge increase in book value per share over the last 10 years, but it's been growing slow, but certainly headed in the right direction, which for some banks, they have not been positive over the last 10 years because of the banking problems in the late 2000s, but you see it has come out somewhat through that and is projected to do all right for the next couple of years. What I mainly wanted to spend time on tonight was talking a little bit about where I came up with First Niagara and then how I finalized the pick. So let's go ahead and do that with introduction now. I first looked at the dashboard round table and drew a big X on it. Nothing particularly wrong with the majority of those companies there, with the exception of the one at the top. I'm not sure why anybody in their right mind would pick it, but I guess I'll hear more about that later on. I just decided that given the fact that the market's somewhat turbulent at the moment, uncertainty of the election year and the like, that I would stick in the sweet spot, that being between 5 and 10 points above my par, rather than stretching into the yellow. So that's all that I did. I just drew the line where Mark drew the top one. That's what the X means. The next stock in line was Hawkins. Hawkins is one that has been picked. Has it been picked twice, I think, Mark?
It has been picked twice, yes.
I thought so. So it's been in a couple of times, and it's a stock that has interested me, and I kind of watch. But then I noticed just right underneath it was First Niagara, and so again, in keeping with our stubborn theme and being somewhat contrarian with the financial banking area, I decided to go ahead and go with First Niagara, assuming it was the best pick available out there. So that's how I went ahead and did the next step. So next slide. First thing that I did was I did a stock search for all banks and thrifts covered by Manifest, and you can see the criteria down in the bottom left-hand corner that I used. Par above 12, quality of at least good, 55, and at least above average financial strength. And these are the banks that came up, and you see that First Niagara came in second, ranked by par in those, and so that was sufficient confirming there to stick with First Niagara. And another thing that I do when I'm just doing quick screens and verifications without doing significant further investigation is all things being roughly equal, and at least in this case the returns pretty close. The growth is pretty close between Simmons, First National, and First Niagara, and Flushing is not hugely better either. It's just a little behind it. Notice those asterisks indicating not covered by value line. Those tend to, again, in a quick screen situation, kind of be just a tick negative. So I'll stick with those that are covered by the full value line. That doesn't mean I reject them. Those of you who are longtime roundtable attendees know that a pick that I've been very stubborn with is BRLI, Bioreference Laboratories. They are not covered. They would be an asterisk stock. So I'm not saying there's anything wrong with them. It's just in this quicker due diligence, if you will, I will tend to favor those that are covered in full by value line, which again is something that I did. I took a look at the value line potential low return, which was on our first slide, and that was at 16%, if I recall correctly. Yes, which again tended to confirm the manifest figure as well. And then I went ahead and just to confirm that even further, making sure there wasn't anything better out there, I did the same screen on value line. I took a look for banks and thrifts with at least a B++ financial strength, which is what First Niagara's is, and it ended up having the second highest 3 to 5 year total return, second only to Bank of New York that you see there, which is not quite as good on manifest. So I decided to stick with First Niagara. So that's how I came up with the pick. Then let's go ahead and take a look at the Eagle. And here is the manifest equity analysis guide on First Niagara. And I just checked the key judgments that you have. First of all would be return on equity forecast, which is 7.4%. Again, by general historical standards, that's really not very good. You would tend to hope to see that at a 12, 15% return. But again, given where we are in the financial world and the pessimism on banks and the challenges banks are facing, that certainly is an achievable figure. That's not an aggressive projection at all, so it's certainly reasonable. The projected shares outstanding are in line with value lines. That has been facing some dilution, both because of the acquisition they completed a couple of years ago, as well as preparing for the HSBC acquisition that I mentioned earlier, and it's why value line currently gives First Niagara a timeliness ranking of 4, because they feel that just given the general, I think they called it blah feeling of the market toward banks, as well as the dilution, that First Niagara is not going to be going anywhere in the next year, but longer term it certainly looks better, as reflected by the 16% return. Then again, PE ratio of 14 is reasonable by their historical standards. All of that leads to profit 1844, appreciation of 15.1, and then a decent dividend yield, which actually is a little below the current indicated yield, so it certainly has the potential to be a little higher. And all looked reasonable to me, so I was happy with the projected return of 17.2%, and that's my pick this month.
Sounds like it could be an opportunity to be stubborn going forward. We got to wait for this one a little bit, perhaps, too.
I think it would certainly be one that you need some patience on. It's probably not going to sail tomorrow.
Fair enough. Well, thank you very much, Cy. Ken, would you like to take a walk through the report card here?
Well, absolutely, Mark. The report card is on every single dashboard that is out there. It sits at the side or at the bottom, depending on the layout of the page. But the report card basically can be thought of as a series of targets, a series of grades that your portfolio is given, and it's nothing more than weighted averages of what you hold in the portfolio itself. Having some benchmarks to compare against your numbers helps an awful lot when you're reading the report card. And it's also helpful to have in mind what the current MyPAR number is when you're trying to decipher your own numbers. Today's MyPAR, or I guess this is last night's MyPAR, is 7.8%. So that makes the sweet spot 5 to 10 points above 7.8. So there we go with the 12.8 to 17.8. Just nothing difficult, just simple arithmetic, adding somewhere between 5 and 10. And then the portfolio that we're going to be looking at has a weighted PAR, a weighted potential average of 14.2. That places it in the sweet spot, and that gets an A. You know, when your kids used to bring home an A, I don't think most of us would say, how high an A did you get? And the same thing's true about all of these numbers that we're speaking about here. I think once you hit your target, you don't have to obsess over grinding those numbers ever higher, and there's not that much difference really as you move through some of these numbers. Remember, we're doing a lot of this analysis with a crayon, and that means the lines are pretty thick, and that means the numbers themselves are really, really rough around the edges, so that a 14.2 and a 15.1 and a 13.9, they're probably all very close to each other. Some people might even say they're the same number. So the target is to get in the sweet spot on your PAR, and this portfolio's done it. The target in quality for most portfolios is to get into the top quintile, the top 20%. That would be a number of 65 or above. And while 81 is a great quality for any portfolio, it's really not that much different from a portfolio that might have a quality of 75 or 72. Again, once you get into that A zone, there's not much difference between the top of the heap, so we say. The growth number we get from reading a lot of better investing materials that suggest that we should be able to beat the market by about 5 points with a portfolio that has growth somewhere in the 10 to 12.5% range. The growth of this portfolio, again, it's a weighted average, and this is sales growth, growth in revenues. This one is at 11%. That's certainly in the A category, so there's the third A. I'm jumping all the way down to financial strength. This one's a little bit more personal. Financial strength is a combination of what Value Line thinks and what Morningstar thinks, what Standard & Poor's thinks. And remember that if you're trying to convert these to value lines, 90 or above would be at the A+, almost the best you could possibly get. I like to set a target there of somewhere between 75 and 80 for portfolios that I own. So I think that that's the bottom of the range. Let's say 80% or better gives you another A in this portfolio, so one more check mark. And earning stability is how good the lines are on the EPS side. How straight are those lines? How consistent is that earnings? And again, I like to set a target of around 80. I don't think I'd argue with anybody that was at 75 or maybe even 70, but I like to set a target of 80 for my portfolio, and the weighted average of this one is 86, so one more A. I do check the PE value of the portfolio. I like the PE value of the entire portfolio to be somewhere close to the value of the PE of the market, and that's a variable number depending on how you measure what the market happens to be. But this 18.7 is pretty close to what I understand the PE of the market is today, which I think is somewhere in the 15 to 18 range. So I just check it. It's not an A or any other grade. It's just I find it to be comforting when that PE value is around the average. I would be worried if the PE value of my portfolio crept into the mid-20s or high 20s, for example, because that would suggest that I'm probably taking too much risk with my money. The last thing I look at, and I applaud myself when I have yield, but I don't chase yield. If it comes, that's great. If it doesn't, I understand that I'm buying growth companies. So I applaud the fact that besides all the great growth in this portfolio, it's also yielding 1.5, and I move on. It's okay. So if my child brought this report card home to me, I think this is an all-A card, and in addition, it has a great handwriting grade and a great phys ed grade, Mark.
Great. And we can see it's pretty well diversified by size, too, our growth rate of the companies. We use growth as that indicator, pretty much split 3 different ways. And again, we do not sit down and intentionally do this. We all operate independently, so we don't, I mean, we would step in if something got out of control, if we had way too many small companies or way too many large, for example, but this just kind of happens naturally. And the same is true down with the sectors. We have a little bit of abundance in technology, but not bad. Not considering where some of the opportunities are these days. Pretty well diversified when it comes to sector. So we're pretty happy with where things seem to be naturally evolving over time. We do make copies of this presentation available on our website in the Manifest Forum. The presentation itself, the audio recording, will be available under our past events screen, and you can certainly get it by writing to any of us if that's easier for you. Email-wise, we'll tell you what link to go to. We put them up as YouTubes and other things. So don't get too concerned about the slide. This is just simply preserved for posterity of time. These are the largest holdings in the tracking portfolio at the present time, ranging from the largest holding of Walgreen at 7.6, then obviously it goes all the way down off the screen, but you can just see some of the more favored companies that we have. You heard Cy mention BioReference Labs a few minutes ago. That's one that has performed very well over the last several months. Many of these have done quite well. By the way, TJX is one that we probably will talk about a little bit tonight. $1,000 invested in TJX about a little over a year ago is now worth almost $2,000. So that's pretty cool. And then again, just for preserving and again thinking about in terms of shopping, I've got the next 3 slides broken down and sorted by projected return. So these would be the nosebleed or the stratosphere stocks up at the top. Some of us, among the 4 of us, are more willing to go into the yellow zone, the potentially too good to be true zone. And then as you've heard Ken and Cy mention, a lot of times they're much more comfortable shopping down here in the sweet spot stocks. And the sweet spot goes on for a while. Here's the other stocks that are still in the sweet spot. Again, we look at this portfolio, we think it's very well positioned. And then we get finally to the bottom screen where again, there's virtually no weak companies in here, even TJX, and this is something I wanted to point out. When the update comes through on TJX and some of the analyst expectations are ratcheted up, I think we'll see TJX go up to about a 4 or 5% projected annual return, so that's something you want to always factor in. It's in the current update cycle right now, so it's always something to think about. But again, when many of you out there have talked about, well, you guys really should be selling something. We just basically say, well, none of these are really that low. You know, all of these in this range, and guys, step in if you want to reinforce this one. These are all still good numbers. I mean, these are all basically around market pars, and those are all good. These 2 at the bottom are a little bit low, but I look at this portfolio and say, we don't need to sell anything. That's kind of my take on it. It's not necessary, and there's nothing there that is screaming out that it's in need of any protection. So that's why you're not seeing more challenges. If we pulled this up and TJX was -6, I think we'd be having a discussion. That would be my guess. -6% projected return is what I'm saying. But it's not. So that's the ones at that end of the spectrum. So we'll just leave it at that for now. With that, Ken, go ahead and take us away into the world of repo. As he's unmuting himself.
I'm going to take the screen here for just a little
Okay.
bit. And I'm going to start by showing you the value line for portfolio recovery, because it's not one of those nice, neat value lines that come from the value line 1700. Portfolio recovery is in the small and mid-cap value line. For purposes of disclosure, I've owned this company now for almost 10 years. I've made considerable profits on the company. I like the story. Most of the time during the entire 10-year history that I've owned the stock, and that includes what happened to it during the recession. And I'll talk about that in just a moment. What I'm getting off the mid-cap here is no low average, no low price appreciation numbers like we like to use to help us check out a stock selection guide. So I do get a little bit of the financial strength flavoring from value line, a little bit of price growth and earnings predictability, both pretty good numbers, by the way. But I'm not getting much in the way of any kind of endorsement of the stock and anything that I look at when I look at a big value line sheet. Notice over here, projections, I only get them going out a year, maybe two, and then only on a couple of numbers on this small and mid-cap sheet. So I'm stuck with doing an SSG basically on my own, and that means that I want information. Now, I've already presented this company once to the group, but I'm going to show you where I go for information. I just answered an email today from a woman that thought I must have a magic source, and I don't have any magic sources. It's just stick to it until you find what you need, or if you don't find what you need, you have the courage to abandon the study. Here's Portfolio Recovery's website. I went to Investor Relations, and here under Investor Relations were presentations. This company is not easy to understand, and while it's not, because it's not easy to understand, a presentation like this on the website is just a great tool to have. I've looked at this a number of times, so I'm going to go to some of the slides that I think are really easy for people to grasp, and then to maybe start to analyze a little bit. I'll start with this slide that shows that portfolio recovery is basically broken into two branches. One of them called debt purchasing, and that's the traditional thing we think that portfolio recovery does, and that's a good old-fashioned debt collector, both for core assets and in bankruptcy situations. But the business also has another complete side to it where they do fee-for-service, different kinds of things for governments, for claims bureaus, and we'll look at that just closely in just a moment. Here's the debt purchasing broken down, and notice what they've done here. They've purchased more than $41 billion in face value debt for an investment of about $1.2 billion. So they're purchasing it on pennies to the dollar, and so they can afford to really play ball with people that are wanting to settle up old debts. Even if they play ball with these people and settle maybe on 15 or 20 or 25 cents to the dollar, you can see that portfolio recovery has the potential to make some really good-sized profits here. In the bankruptcy cases, I want you to notice down here that they've secured more than $16.5 billion in face value, and they've spent $750 million to do it. So again, they have a lot of traction to offer different settlements that will not only be good for the people that are paying off some of these debts, but it will be wonderful for portfolio recovery. Here's the business, however, that I think is really misunderstood by a lot of people, and it's becoming a sizable part of portfolio recovery's business. Basically, what they're willing to do is they're willing to handle tax payments and delinquent taxes and identification of unpaid taxes and the auditing of tax payments. They're willing to do this for municipalities. They're willing to perform skip tracing, asset allocation, and collateral recovery services. This is primarily for auto finance. I mean, you've seen the guys on TV that put the boot on and truck the car away. I'm not quite sure portfolio recovery is into it to that degree, but this is the kind of thing they're doing. And then down here on the bottom, you also see that they're a provider of class action claims settlement recovery services, so that when somebody makes a class action suit against one of the stocks you own, somebody has to handle the settlement, and getting all those little tiny checks out to us little tiny investors, and then that one big check to the lawyers. That was a soapbox moment right there. What I want to show you is that that part of the business, and that's represented by the gold section, didn't even exist when I bought this stock. This stock was basically a core and fee-for-service business. But when we move out to 2011, we notice now that they've moved heavy duty into bankruptcy. We notice that their fee-for-service business, that's the delinquent taxes and all that stuff, has really increased from where it was. So this business is really busy providing a different face to the public and really busy diversifying itself on a year-to-year basis. I'm just going to go one more slide. There we are right there, and just also show that the amount of debt that this company has purchased in just the last 3.5 years is staggering, and they were able to purchase all this debt because we had this thing going on in the country called this Great Recession. So they sit with this portfolio right now of uncollected payments, and their job is to turn those uncollected payments into the bottom line, into profit if they possibly can. This presentation goes on, and I would suggest, if you're interested in the company, that you take a real quick look at it. I'm going to move real quickly to my toolkit. I want to show you that the lines are, in mid-Michigan parlance, up, straight, and parallel. You know, it's pretty nice looking company, especially when you consider that this straightness right here had to do with the whole company falling into the dumpster for a couple of months right there. I like the analyst estimates, which are on the high end of my projections. I love the fact that this company is operating on margins that just blow out any of the competition, and return on equity at 20% is good for almost any company that I like to look at. On top of everything else, it's trading at a very, very reasonable PE, less than 12 compared to maybe 14 for a 5-year average. All in all, my 18.6 par number comes very, very close to where Manifest is, so I'm going to double down on Portfolio Recovery Associates, PRAA.
Sounds prudently stubborn.
Something that I noticed that's interesting, I have not looked close at portfolio recovery for a couple of years, but just if my quick math was right, it looks like they actually are willing to pay more for purchasing debt in bankruptcy than for the typical debt. Might seem counterintuitive to a lot of people, but when I noticed in there what the sort of bankruptcy that they were purchasing, a large part being what's known as Chapter 13 debt, excuse me, you have to realize that if they are purchasing approved Chapter 13 plan debts, or even a debtor that looks like their Chapter 13 plan will be approved, that's actually not, that may be a better person to collect from than just someone who has 10 or 15-year-old debt, because you are required as part of your Chapter 13 to make a certain percentage of payments by the court. So while they're buying it on pennies on the dollar, they may know that unless this person blows their Chapter 13 plan, the plan is that they'll be paying 50 cents on the dollar. So I just found that interesting.
That is pretty cool. That's quite a viable repayment stream if you think about it.
Mark, we have a hand in the air. Mark, Chris Hodgkin's hand is up. So, Chris, I'm going to unmute you. Let's see how your sound works.
Are we working okay?
Hi, Chris.
We're hearing you fine. We're hearing you just fine, Chris.
Okay. Debt is naturally has a lifetime because of there's a limited amount of time you can collect, and then it's uncollectible legally. I'm wondering two questions related to that. Number one, do they report how close some of their debt is to going out of its legally collectible time frame? And number two, do they attempt to collect debt that is actually legally not owed? And to me, that is an ethical issue. Because there are some debt collectors who will, even if your 6-year statute of limitations has passed and you don't owe this money, there are some debt collectors who will try to go after it anyhow. And I don't know if anybody else considers that an ethical
Chris,
problem.
the answer to your first question, Chris, is that presentation breaks some of those numbers out, and you can get a feel for how much of that debt is older on the old side. The second question, portfolio recovery makes a really big point of polling its customers. Now, its customers aren't always very happy with what it does, but they try to find out, did we treat you fairly? Did we, the whole gamut of questions, and then they report a lot of those polling results. So at least from the things that are being reported, not only by them but by the industry, portfolio recovery seems to operate well on the positive side of the ethical question.
Yeah, and they do some remediation, so they do some real positive stuff too. So cool. Thanks, Ken. Let's go ahead and spend just a couple of minutes. Don't want to run too long on this, but just talking about long-term performance. This is something that we do try to touch on every month. You can see that we're not where we want to be yet. I do want to spend a couple of minutes putting that in even better context, I think, as to what we're trying to do over the long term. We've even slipped back on our accuracy a little bit here, dropped back down to 40% or so. We do want that to come in somewhere between 60 to 70. But what I want to talk about here for just a few minutes is just a little bit more concrete or context, a better concrete understanding of the relative return objective and some of the history. And this is where we promised some of the locals, the Better Investing Brighton Model Club, we're going to put your name up in lights. We want to put this into context. This is a model club. I know many of the participants in this club, and again, you guys can all take an ether bow, cyber bow. This club has actually turned in an internal rate of return of 18.2 since May of 2007. So they're literally coming up on their 5-year birthday cake, and literally churning in a relative return of 8.4. We get the 8.4 by taking their actual annualized internal rate of return at 18.2 and subtracting the benchmark, in this case the S&P 500, to come up with that 8.4%. That's just nothing short of cool. That's where you want to be, and we need to celebrate people who do that. So again, they're about 5 years, over 5 years. So that's one piece of information, and 8.4 for the second. And now we want to put that in a little bit of context, and this is where you guys can get ready to have some goosebumps. We talked about it this weekend a little bit. This is a graphic showing basically a bunch of portfolios, including clubs and professional mutual fund, managed portfolios. We've got years of operation on the x-axis, anywhere from 0 to 5, all the way out to 30 years out here. And then on the left-hand axis, or the y-axis, we've got anything from positive 15 relative returns down to negative 5. Okay? Well, here's Brighton. This is the number we just went over. So you can see that, just looking at the scatter on the chart, not that many balloons are higher than Brighton over the long term, or for that matter, the short term, as we fill in more of these. And keep in mind that here's our objective at 5%, And here's your colleagues up the road at Mid-Michigan doing pretty well. Here's in fact Ken's investment club that we featured in Dashboard Diagnostics last year. These are all pretty solid things. I mean, I put these clubs, here in the sponsoring chapter in the same type of. They merit the same type of grades as people here that like this one. Here's Peter Lynch. We're on a first name basis here. Peter Lynch. Warren would be Warren Buffett. That's Berkshire Hathaway, over 20 years. And then out here on the far right, a guy by the name of Walter Slosh, one of Warren Buffett's buddies, and somebody we'll probably be spending more time talking about between Walter, Warren, and then here's the 10-cup portfolio that we feature in our newsletter. So these are all really cool performance levels. By the way, this is Ken Hebner of CGM Mutual, Professional Mutual Fund Manager. So this is Ken Hebner, so we'll just give him a KH. And that's why we pay so much attention to him. So as we fill this in and add more and more data points, I think it'll get fascinating. The other thing I want to point out about this is if I went out and did a scientifically or statistical sample, for every one of these red dots that's up here, there'd be 8 to 10 dots down here. Okay, just by what we know of mutual fund performance. So we literally will have an explosion of red dots down here. Again, keep in mind, anytime you're in this zone here, you're doing okay. So we see a few clubs in this area. This is where the round table is, but we are just getting started. In fact, what I generally tell relatively new clubs is don't even really keep score for real until you get a few more years under. Maybe get out here into this range or so. So just some things to think about. By the way, the Mutual Club of Detroit, 60 years. The relative return on that one was plus 3.4%. That was from 1941 through 2001. So that's kind of an interesting data point. And then one last one I want to share, and then we can open up the floor for comments before we move on, is this little green critter out here on the far right. This happens to be, the ticker symbol for it is VAY. I can't, my mouse is not cooperating, but VAY with a caret in front of it. That's the value line arithmetic average. And I think we should all find it a little bit fascinating that the value line arithmetic average on a 25-year basis has outperformed just the general stock market benchmark by 3.5%. This distance that you see right in here. That's just, again, more reinforcement of that story we constantly tell about. You got to have small, medium, and large. You got to have a blend of faster growing companies to balance out with your slower growing companies in your portfolio. And we're going to have some fun looking at that. I've actually, for the first time, pulled out the S&P 500 so we can see the impact of the medium and smaller companies in that situation and what they've actually contributed. So with that, Ken, any comments? I mean, some of your dear friends are here. Some pretty cool stuff going on.
These clubs are amazing, and every time I listen to my friends on CNBC bring on a professional that tell me that amateurs can't do any of this and we should lay down our money in front of them and just turn it over to them, I just remind myself that I know lots and lots of people that are able to beat the market and are able to do it on a relatively long-term basis without spending every waking moment managing their portfolios.
No, and as I've told the story before, I mean, Ed Finn, publisher of Barron's Magazine, he says, maybe one of the real tools in the arsenal for investment clubs is the fact that they only meet monthly and that they aren't there making frenetic decisions every other day or so. So there's just a whole lot to this, and we'll be basically reaching out and trying to build this picture out, because I think what we're going to discover is something just absolutely phenomenal and fun. But again, I think over the long term we expect to see Roundtable come up here.
Mark, I've been reaching out to model investment clubs throughout the country in the last couple of months, and if any of you are in a model investment club at another chapter, feel free to send us your relative return report from either the iClub accounting or the Bivio accounting. Both accounting systems can write you a really nice report, and we'll put your dot on here with your name attached to it as well. Send it to us, especially if you're above 5%, but send it to us no matter where you are, because it'll give you a place to start and a place to maybe say 3 years from now, here's where we were and here's where we are now, because we changed the way we think a little bit about investing.
Yeah, and here's an example of that. Again, we're in a time frame when we probably shouldn't even really think that much about it, but the roundtable itself is coming up on 2 years, and we just hope that we're headed in that direction longer term. It's really simple to keep track of, and I think you're going to be fascinated by some of the stuff we kick around, like when you take a look at Bill Miller of Legg Mason Value and what happened to his 15-year winning streak. When you look at it in this context, it's just a lot of fun. And it's also a reinforcement as to don't pay too much attention to any one particular year. So good stuff. All right, with that, let's go ahead and move on, and I'll get out of the way for Hugh because Hugh's got a number of slides here. So let's go ahead and provide the entertainment portion of tonight's session. And I've entitled this From Mattresses to Mobile Devices, and my selection for tonight is RIMM. That is one that is down 70% since someone here selected it a few months ago. But what I'm doing tonight is making good on a promise, I think. And this is the promise, and here's the scenario. For those of you that are not familiar, Select Comfort is that Sleep Number company that makes the mattresses. And a little while back, a friend of mine called, and it was at a time when the company was approaching that stock price of 19 cents. It wasn't quite down to 19 cents, but it was almost down to 19 cents. And it was one of those stories where the marketing manager had quit, and I don't know, the CFO had been cited in Brazil. You know, everything that anybody could find to write nasty about this company, it was going on. And in the meantime, the price was just diving and diving and diving down. And his message to me that morning was, do you really think the last mattress has been sold? And I said, well, housing and all, yeah, but do you really think that, you know, the last mattress has been sold? Do you think these guys really will ultimately fail and go away completely? And I said, well, I really don't know. Well, they had no debt, first of all. That's an important consideration anytime you're having this discussion. And they had, you know, not the best financial strength, but a decent financial strength at B+. So B+ financial strength, no long-term debt. The pendulum there is just simply a reminder that, boy, in the world of investing, I've been around long enough to see that dude swing way too far one way, way too far the other way. And in this case, if I could have summoned the courage just to take a little bit of mad money, a little bit of speculative risk capital, $1,000 invested in Southern Comfort back shortly after I received that phone call, and again, if I could have led myself to believe that the last mattress had not been sold, check out this number. $157,000, and it still seems to be going up. And that's only a couple of years ago, guys. So, I mean, these type of situations do present themselves. Again, no long-term debt, decent financial strength. I mean, I can think back to a remotely or almost similar situation, not quite as nasty as this one, with Garmin a few years ago, where I made a bad choice to go into that on the way down. But if I'd really, instead of licking my wounds, if I had gone back in at a moment when it kind of bottomed out, could have recovered all of that loss and then some. I think we might have one of those today with Research in Motion. Research in Motion is a company that is in shambles. There's been a changeover in management. We see a projected return here. The low total return at Value Line is up in the 40s. Our projected annual return now, after correcting for some of the recent adjustments, is down in the 20s. It's clearly a company that has been just absolutely hammered down in stock price. If you want to read bad news, there's plenty of bad news and horrific stories about it out there, but we're down here, folks. We're actually down in this $12 to $14 range. And, you know, if there's a company there that could still survive going forward, I mean, keep in mind right here, big time, they have no debt. They also have something. You know, I don't know what they have either. They're kind of one of those companies where the real assets of the company ride up and down in the elevator and drive home at night from the parking lot. But I'm looking at a company that has a book value that's estimated somewhere in the $20 range, and the company is trading down closer to $10 a share. So I think I have a chance at experiencing a little mattress revival here, kind of a similar situation. Think Garmin if you want. This may be one we have to wait for a while, but I certainly would like to see the roundtable tracking portfolio benefit even partially from a gain a little bit like that. That's 158 or 159 bagger, I think. If not, it might be even off by a decimal point there. So I think, again, we may have to wait, but I think it's worth taking a relatively small part of the portfolio and going for it. I'm also making good on a couple other things. We had actually sent, CNBC had a stock picking contest just the other day, and kind of a cyber friend of mine that he's become a little bit famous here. His name is Joshua Brown. This is his book, Backstage Wall Street. He and I had exchanged a dashboard, so he actually had a cheat sheet for this draft that they did on CNBC. And this is what he would have been looking at. And by the way, he did select Research in Motion with the first selection in that draft. You know, they had Kramer and all the celebrities there. And a couple days in, at least he's looking okay. But again, we're looking at a elevated return, and they're going to pick the winners by the Super Bowl. You can look at that dashboard using that link at the bottom of the page. And then I'm going to leave you with one last thought. We do pay a lot of attention and respect for people who seem to really know what they're doing. I count David Einhorn among that group. His annualized returns over the last 20 years or so border on 20%. And I just want to leave you with one quick comment here. Research in Motion is their largest equity holding, and they bought into it late last year when the stock price had gone underneath 20. Not a great company, but it's really been beaten down. They've got some assets, they've got some patents, they've got some stuff. Here's a link for you to look at more of the details as to what he thinks. But again, it's an opportunity for an outsized gain. And it clearly is rolling the dice a little bit, clearly speculative, but we've always said we can do a little bit of that with a portion of the tracking portfolio at the round table. So everybody cross your fingers, throw a little salt over your shoulder, in any of those things that'll help us here, and we'll hope for the best.
I just note, Mark, that you made a very interesting, perhaps Freudian slip when you were talking about mattresses. You said if you had summoned your courage and Southern comfort, you could have made a significant profit.
You know, I keep making that mistake in these presentations, and I'm not doing it on purpose. It's the intervention will be.
Mark,
yes.
Mark, I'm dusting off my Just for Feet slides. And I'm gonna bring up the tape of last convention when we talked about investing, things that we were ashamed about. And I think Hugh and I had the same story that ended with the sentence, "How low can it go?" Didn't we have that?
That's right.
Well, let's find out. I mean, who knows? Let's see what can happen here. All right. With that, I'm going to turn it over to our green-helmeted Irishman here. Hugh, take it away with Southwest Airlines.
Well, thanks. I'll probably go at a reasonable clip here because I've gathered all the slides together, and I think they'll point to very useful websites for folks to get information on the airline industry. And I've owned Southwest Airlines for many years, probably 20 years at this point. It was at one point a phenomenally good growth company. It's now probably very mature, and I wouldn't expect Southwest to be held in this portfolio for more than a couple of years, and I'll show you why later. But I think it's a good industry to study. Someone has to be the winner. Somebody wins in every industry, and Southwest has certainly dominated it for many years. It's also a good way to look at an industry that's highly capital intensive and has a very high break-even point. And it's unique because if you think about it, the costs that airlines incur, mainly fuel and salaries, are pretty inelastic. They don't change. The schedule doesn't really change depending on how pricey oil is, whereas the revenue side is highly elastic. So if oil goes up, it's very hard for an airline to recover costs from customers without losing some of those customers. So it's a tough place to be. So let's skip to the next slide. Oh, Walgreens came in. And we were talking about early mistakes that we made and so forth, or opportunity costs of not buying something, and I thought I'd just throw in an example I had. It was years ago. I worked in the food industry, and we had a particular interest in fruit beverages, which were popular in the early 90s with the advent of Snapple, and of course Coke came in with Fruitopia. So I used to visit a lot of those companies. For me, I'd only been investing for 4 or 5 years. This is about 94, 95. And obviously was a big fan of Peter Lynch in his book, where he advised people to buy what they know and urged you to buy things that are staring you right in the face. And I've learned many times, if something's staring me right in the face, it doesn't really mean that I'm going to notice it. And I certainly didn't notice this company, even though I lived in Jersey at the time and enjoyed flying out once in a while to visit it in Corona, California. I picked the company, which was Hansen Natural, or Hansen Beverages, back a few years ago for the stock picking, well, I don't know what to call it, a competition, but I guess it really is, at the national convention that they have. But it hadn't been in my radar screen for many years, and it was kind of painful because when I adjust for splits, it was trading at about 4 cents per share in 94, 95 when I bought it. And I noticed that today it hit almost $85 per share on rumors that Coca-Cola was going to take it over.
That's right.
It was a completely unfounded rumor. Yeah, that's a 200,000% return. Never even dawned on me to look at this company at all. But in fairness back then, because the portfolio was small, it was young, and it wasn't vulnerable, it would not have passed an SSG. So I never would even have considered buying the company, even though I loved the people. I thought it was going to be highly successful. I loved what they were doing. The beverages were great, etc. It had all of those Lynchian characteristics that we all know and love, and it was screaming at me, even though I couldn't hear it, to buy it. But I didn't. So opportunity cost there. And by the way, I hope I sound better this week. I'm using a new Yeti Pro microphone. So it's very Larry King-esque. It's a great little microphone. I hope it's picking up the sound well.
It's Larry King and Lou Rukeyser all in one.
Yeah, you can get all kinds of contraptions for it, so you can hang it up the ceiling, etc. So Southwest Airlines has already been picked, and I thought I'd go at it again. This month, my preference really is to buy companies we've already bought because the portfolio is getting pretty big. And I did the exact same thing I think that others did. I went through and really looked at companies that were, I guess, close to their 52 or multiple year low. And Southwest was one of them, as were some of the others that have been discussed tonight. It is a discount airline, although I'll talk about that in a second. It has gone from a small regional player just in Texas and Oklahoma and the surrounding area to really a national carrier. It has 46,000 employees and there's almost $27 billion in revenue. And the stock price is pretty depressed right now for various reasons that I'll touch on as we go through it. The company actually acquired AirTran, which is a competitor based in Atlanta's Hartsfield Airport, and that sale closed early last year. Southwest actually carries more passengers than any other airline in the country. And on the next slide, there's a few more facts on the airline. It has 3,300 flights, almost 600 aircraft. They're all the same. So if a skipper is rated on the 737, he or she can fly pretty much any of the 737s in the fleet. I say almost any because actually some of the older, the 300s and lower, I think they still have some 300s. You have to get a different rating for those, but anything that's a 400 and above, they don't fly any 400s, but they have 5, 6, 7, 8s, and I think they will take delivery of a 9. They certainly have 8s. Same crew can fly those. So it gives great flexibility and it does lower costs as a result. The fleet is quite old now, 11 years, but that's not old per se. But it does point-to-point, generally short distant trips. And the single aircraft will fly 6 flights a day and it'll be in the airport over half that day. The shortest flight that Southwest travels is about 133 miles. It's in Florida, and it goes from Fort Myers to Orlando, and then Providence to Las Vegas at almost 2,400 miles is the longest. It's quite a good load factor of 80%. And it serves 72 cities, so there's a lot of markets still potentially available to Southwest, and at least 13 states. Actually, maybe not that many, because going to Hawaii might be a bit of a push. So let's move to the next slide. It actually saves money or lowers costs by booking most of the flights through its website and having the vast majority of its passengers check in at kiosks. It actually was the very first airline to have an operator website. And the average ticket price is about $142 each way. And it actually has the fewest customer complaints filed to the Department of Transportation. And there's a website that I can show people later there. And Herb Kelleher, of course, was the founder of the airline and the CEO for many, many years. Quite the character, much beloved, but has retired and gone on to greater and better things since then. So if we move on, I'll show you a very good site if you want to gather airline statistics. It's the Bureau of Transportation, and it's the statistics site. The URL will come in a second. If we move on to the next slide, there's an example that you can see of where your money is getting spent, the share that the various carriers own. Southwest, and this was before the merger with AirTran, owns about 15% of the total market, slightly under Delta, which at that point includes Northwest. That merger occurred about 3 years ago. The Continental and United are still broken out as two separate carriers. And if we go on to the next slide, I think we have, no, the URL is in the following slide. Again, this came from the Bureau of, the DOT Statistics website, where you can see what the most expensive airport is. Not surprisingly, it's LAX. They actually list the top 40, and this is for all carriers, not just Southwest. But Southwest flies into many of these airports, not really Orlando, but now they do fly into Atlanta, to Boston, to San Francisco. They were in San Francisco a number of years ago, left because of delays. Now they're back in there. In fact, they were in Denver originally in the early 90s through the merger with Martin. Then they left Denver, again, because of weather conditions there, causing problems in their system. But since then, they've managed to move back into Denver, and they're doing quite well. And on the next slide, as promised, I think you see the URL for the Bureau of Transport Statistics. And if you go on that site, there's just a wealth of information. It actually shows you the average ticket price per city pairs in the U.S. So there's 100 cities, which means that there are 10,000 city pairs, and you can see the average price per month for each of those city pairs in the U.S. Lots and lots of data for if you're somebody like me who likes to kind of read that kind of stuff. And here we can see that Chicago to New York is probably the most expensive route to fly. 10th most expensive is Chicago to San Francisco. Chicago features quite prominently among the top 10 most expensive domestic routes in the U.S. for February through January, February of last year through January of this year. And moving on to the next slide, we have some Southwest specific information where we see their top cities. The far right, and this is from the Southwest website, shows when that base was established, and Chicago is now their biggest, Chicago Midway is their biggest airport with 226 daily departures. That was just established in '85. They moved into Denver again, most recently in 2006, already have 154 departures out of there. And Dallas Love Field, actually, which is where the carrier started back in 1971, June 18th, 71, only has 127 departures. No longer the dominant airport in their system, but it was once. And if any of you know Ron Bruin, who has spoken at the National Convention, lives in Orange County, he actually ran the Southwest operation out of LAX for many years. He's now working out of John Wayne Airport in Orange County. It's, I think, number 8 on the list there of their busiest and biggest airports. Interestingly, they dominate Oakland as well. Most other carriers have pulled out there. Here's some data from Southwest, which you can pull out of any website you want, and any airline you want from the Bureau of Transport Statistics website. It just shows the number of passengers, the enplanement as they call it, at each of the 5 busiest airports. It shows the number of passengers that were carried, and this is in millions, number of departures, etc. And some of the statistics that are very important in the airline industry are RPM, which is revenue passenger miles, and ASM, which is available seat miles. And that is, they take up the number of seats in the system, the number of miles flown, and they multiply the two together. So one ASM is one seat in their inventory flown for 1 mile. And you can see the load factor has been improving. This is on a rolling 12-month basis. It's gone from 79.6 to 80.8%. Doesn't seem like a big jump, but if you think about it, this is a company with high fixed costs. It doesn't really cost that much more to put another passenger on the plane. A little bit of fuel, but nothing significant. So the more passengers you get on the plane, the more profit you generate. There comes a point, it's usually at about the 70%, 65% area where you start to make a profit. If you actually look into the statistics for an airline like Southwest, or United / Continental, Delta, etc., they're only making $2 to $3 per passenger per trip. It's not a very nice business to be in. So if we skip to the next slide, this is taken from a great site, airlinefinancials.com. It's run by a guy called Robert Herbst, Herbst just like the German for autumn, who was a retired American Airlines captain and has since dedicated his time to running this website where he looks at the financials for airlines and does some nice comparisons. The challenge here is that these numbers used to be readily available, but there are very few places you can go to get them to work it out for yourself. So this is a very good service to people. And if you look at the far left-hand side, 2002, that little purple star, that's where Southwest started, and it's the operating unit revenue, the revenue per available seat mile. And it has increased steadily from 2002 up until the latest year for which these numbers were reported, which is 2010. And it's now kind of where it's sitting right in the middle of where the other carriers are. But there are some cautionary tales about Southwest, and we'll touch on these in the next few slides. If we move to the next one, you can see that we're looking at unit costs. And the unit costs are increasing as well. This is the cost per available seat mile. Southwest, which again is at the bottom of this chart in the light purple, is still doing well. Its cost per available seat mile is lower than its competitors. But that gap is narrowing. And the gap is narrowing for a number of reasons, not least of which is the fact that all of the major carriers, the latest being American, have gone through reorganization, Chapter 11, bankruptcy, which is a way that they can actually lower their costs pretty quickly and pretty dramatically. And in the case of Continental, Delta, Northwest, and United, it put them, well, not Continental, but it put them on a par with Southwest Airlines. Continental hasn't gone into bankruptcy recently, and of course, the airline no longer exists, the merger not being complete with United. So we look at the next slide, we'll look a little bit more into costs. The purple again shows up on the far right, second from the top, that's Southwest Airlines again. But you can see that its total labor costs per available seat mile are climbing, and they're getting to the point where they're higher than many competitors. A cautionary tale. Now the competitors' costs are going to climb, but this is a cautionary tale that Southwest isn't the young, agile airline that on slide 39 for the pilot's salary. Pilots are very well remunerated at Southwest. They're the most expensive at the moment. Over on the far right, this is the dollars that they generate per available seat mile. That's Southwest, way above where everyone else is. It used to be the case, if you look in the far left, in 2002, Southwest had actually the lowest payment for pilots. Things are changing. Now, Southwest is nowhere near going into reorganization to solve its cost problems. It really doesn't have them. It's a very competitive airline. It has lower debt than its competitors. It's doing quite well. But this is a cautionary tale that I think the salad days for Southwest are coming to an end. And I think there's just a few more years left when this is kind of going to be a growth stock. And I'm hoping to eke out those last few years in our portfolio. And then finally, on the next slide from Robert Herbst's site, we're looking at the average wage, the average salary per employee, and you can see that Southwest is way and above its competitors. Now, we've shown earlier where they're pretty productive, but they're still on average getting close to $79,000 per year, whereas U.S. Airways, their salary is about $56,000 a year. I guess the tale here is to work at Southwest, but of course, airline industry being what it is a bit like a pyramid. You start low and you gain seniority and your salary goes up over time. But Southwest now has a lot of very senior people, and when I run into Ron Bruin, I need to talk to him to find out if we're going to hit a retirement cliff. This often happens in airlines where waves of retirements are occurring at any given time. This could happen with Southwest to kind of reduce this cost in some way. But it's pretty clear that Southwest is going to be driven into a new business model with these high costs, and we should watch for this happening over the next few years. So let's skip to the next slide. And This is just the average revenue per employee. So these over on the right, you can see Southwest is right in the bunch with all the other airlines. It's never really has been much more productive than anyone, but it's not falling behind, and it's well up on the top of the bunch. So it's doing okay, but it still has an issue and a growing issue with costs. It's no longer the low-cost carrier as it once was. So on the next slide, we're going to move into the stock selection guide. Here we look at Southwest. It got a bit of a ding during the Great Recession, but it's now back on a growth trajectory again of about 20% a year. Now, I have picked a growth rate of 12%, slightly higher than what analysts are saying. But as the economy recovers, I would expect companies like Southwest to recover too. And on the next slide, it shows all of the judgment calls that are made when doing a stock selection guide. And just as luck would have it, the earnings per share estimate that I came up with of 66 cents seems to be what analysts are predicting for 5 years hence. Just a bit of a fluke there. I throttled back a bit on expenses, lowered the tax rate from 45, give or take, down to 40. A little higher than it has been on average. It's been slightly lower than 40%, 38%, and increased the number of shares outstanding. But it gives an EPS growth rate of almost 24%. And as I said earlier, it shouldn't be surprising, because as the load factor increases, as the business will get back into the nice part of the business cycle improvement, then everything, these extra passengers, become as close as you can get to pure profit. And then going to the next slide, we look at part 2 of the SSG. Yep, things are trending down a little bit for Southwest in terms of the pre-tax profit and sales and its return on equity. It is carrying debt, and it is carrying probably more debt than it has in the past. It just made a major acquisition. But it's still in somewhat better shape, I think, than many of its peers. So if we move on to the next slide, part 3, we can see that PE has been dramatically inflated recently. You know, I think just expectations of further growth. And the other thing is that the airline does have a dividend, but it has a very small dividend of about close to 2 cents per share. Interestingly, about 20 years ago, maybe 18 years ago, in the annual report or in the proxy we got to vote, one of the requests from shareholders was to eliminate the dividend, and management was absolutely adamantly opposed to doing that. And they won. The dividend stayed. It was less than a penny back then, so it's grown dramatically, almost to 2 cents. So on the next slide, we'll look at part 4 of the SSG, where the judgment calls were made. You know, one of the challenges about picking the high PE is, do you pick what you think is relevant and reasonable, or do you pick what you think the market is going to do? And the market has bid up this PE quite dramatically. So I basically cut the high PE in half and brought it down to 30. And the low PE is at 15. These are 2 big numbers, but you know, the fact is that's how the market has been treating this company. It gives a forecasted high of close to $20. It also gives an upside-downside ratio of almost 15 to 1. Pretty stellar number, but that's driven by the fact that right now, I think this company is somewhat undervalued. I think the stock price is too low based on the anticipated and future growth of the carrier. And it ends up driving some of these other data into kind of the stratosphere, into an extraordinary space. And the compound annual return is close to 19%, whereas the projected average total return is closer to 12%. By the way, that plane up on the top for the eagle-eyed has ETOPS on it, which is extended operations, or engines turn or passengers swim. It's a designation given to certain types of aircraft. They have to be tested in certain ways, but it's a designation given to twin-engine aircraft that are allowed to fly over water for extended periods. So that's why you have twin-engine 767s, 777s, and 757s flying across the Atlantic. This aircraft is rated to fly across wide bodies of water. And Southwest has talked about moving into international markets. I think it's probably only a matter of time that it does. I haven't really kept up with that part of the development recently. But I will dig into it in the next few days and talk about it on the MI. And then if we look at the next slide, it's a nice segue to Manifest, where the projected annual return is 21%. It has pretty aggressive power, but that's sometimes where the biggest fish lie. And all of the other data, the financial strength, a little bit on the weak side, not everyone's cup of tea. The sales growth for the industry is pretty anemic too, but Southwest, I think, has a reasonably good projection going forward, and its quality rating is low. I know that. It's kind of a scary number. The fact is that many of its competitors are worse. That's how you justify being in a gang.
That's right.
When you're a teenager. And then the next slide again is just looking at the bottom part of the analysis, where we can see, and we talked about this offline earlier, that Southwest has quite a dramatic projected average return, the purple line on the top, for various reasons, not least of which because I think people really don't grasp it. I think there is very good upside in this company. But, you know, for the long term, this is a company to watch. If this stock were to double again, I think it would be time to abandon Southwest Airlines unless something dramatically changes in its cost structure. But its cost structure is headed in a direction that makes me very uncomfortable. So I know I'm running over. There's just one slide left, and that's just to reaffirm the fact that I'm picking Southwest.
Good stuff. No, we're coming in at 9:45. We do want to kind of wrap things up. We will leave the floor open for questions, but I just wanted to kind of close things. Thanks, Hugh, for flying with Southwest where your bags fly free. And I think we just wanted to reinforce that you do have an event coming up. Hugh actually leads a discussion on the FDA process, the pipeline, looking for opportunities there. And that, in this case, we'll be concentrating on the obesity drug. That's coming up in a couple of weeks on Thursday, May 17th. You might want to keep that in mind. And then we did have a couple of sessions this past weekend. Just wanted to make sure everybody knows that when you go to events at manifestinvesting.com, you can also access recorded events. And got a lot of positive feedback from a couple of these this past weekend. And as always, we invite you to send suggestions to us at manifestinvesting.com. And with that, I'll say thanks to everybody, thanks to all the attendees, and thanks to my presenters. We'll close down officially, but stick around for a few minutes for any questions that may erupt. Thanks, everybody.